In today's video, I want to talk about a company that in my opinion has been completely forgotten. It's a company that was of course flying extremely high during the pandemic, but in my opinion right now you might actually get it at a better price because the company is growing, but is growing in a profitable way. Plus in the last 3 months, stock is down around 20% or so. Year to date, it hasn't done much since the last year, yet it's up around 20% or so because the business itself has turned around. It's true that it had some struggles in the last couple of months because of the industry that it's playing in. It's playing in the identity security industry. Maybe by now you can already figure out what company I'm talking about. Before I reveal the name, you can write it down in the comment section below, and then you can see whether or not you were correct or not. I can already say it's not Microsoft or anything like that. No, this company is actually called Okta. Yes, maybe you're using it at work, maybe not, but you're definitely familiar with what they're doing. Now we're going to discuss Okta, the current state of the company, the current state of the stock as well. I first want to start off with a small overview of their recent earnings report. This is from Stock Market Nerd. Great follow on X. So for the quarter, you can clearly see it was a pretty good quarter, a beat across the board, and annual guidance has been raised as well. But the stock reacted negatively. In my opinion, that's the best way to go about it. Maybe valuation was again a bit too pricey, but when you see something like this, a beat across the board plus annual guidance, a beat and raise, and the stock goes down, in my opinion, that's a recipe to add to your position, or maybe if you're interested in adding a new position to your portfolio, this might be one of those, let's say, good scenarios. Now, if you want a small description of what Okta is actually doing, well, Okta connects any person with any application on any device. It's an enterprise-grade identity management service built for the cloud, but compatible with many on-prem applications, but there are also off-prem applications that work with it right now. Now, you might have heard this name because last year in October, there was a big hack. So you've probably seen that in the news. They got hacked. But remember, they're not the only one getting hacked. Plenty of big tech companies, even Microsoft, got hacked. But that didn't stop them from growing. That didn't stop them from attracting more and more customers. Now, of course, getting hacked as such a company, you don't want it to be repeated each and every year, because then you'll probably start losing existing clients and future potential clients as well. Now, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's first start off with a major overview of the current state of the stock and the company. Company has a market cap of just under $15 billion, has a forward PE of 36.7 times, as you can see, much lower than its mean of 103 times. EV to EBITDA 26.2 times, price to sales 5.7 times, and price to free cash flow, that's in the last 12 months, that sits at 25.1 times, all much lower than its 5-year or in some areas here 3-year mean. With regards to its trends, total revenue, free cash flow, net income, gross profit, return on invested capital, and return on equity, you can see that the business has been trending in the right direction. Revenue has been steadily growing, but more recently you can see that the company is generating more and more free cash flow. Of course, when you see that, you then go and look at gross profit, net income. You can see that gross profit has steadily grown as well, and net income is improving towards being net income positive. Right now, if you look at the average analyst price target, that sits at $113.9, representing close to 30% upside from the price we're at today. If we look at its 5-year performance of the stock, it's actually down 21.8%. Of course, you get that huge spike here during the pandemic. Right now, the current analyst estimates for the coming fiscal years, it's clear that sales growth remains the same, approximately 12 to 13% year over year for the coming fiscal years. But what you're getting here, again, we've seen that across the board, is faster growing earnings. So EPS estimates for fiscal year 2025, year over year growth of around 50%, followed by 12.5% in fiscal year 2026, and then a serious reacceleration in fiscal year 2027 of around 18%. And so if we look at the earnings report, major overview here, so total revenue increased 19% year over year. Subscription revenue actually grew faster, 20% year over year to reach $603 million. Remaining performance obligations, or RPO, increased 14% year over year, but current remaining performance obligation increased 15% year over year. The difference between the two is that current remaining performance obligation takes into consideration what you can recognize in the next 12 months. If you look at trailing 12 months dollar-based net retention rate, that's down 6 percentage points year over year, basically also flat quarter over quarter, sits at 111%. You want to keep your eyes on that and not see it fall further and closer to the 100% mark. If we look at the non-GAAP gross margin, that's up 2.6 percentage points year over year to 81.5%. Non-GAAP subscription gross margin, 83.5%, that's also up year over year. Non-GAAP operating margin is up 14.5 percentage points year over year to reach 21.6% in this quarter. And so you get free cash flow margin of 34.6%. That's also up 10.6 percentage points year over year. Total customers increased 6% year over year, and customers with more than $100,000 worth of annual contract value is up 12%. So despite the hack, they're still attracting more and more customers, and customers are happily spending more money with them. And with regards to their rule of 40 here, trailing 12 months total revenue growth plus free cash flow margin, that's at 45%. Then looking at financial outlook for Q2 fiscal year 2025, as we've seen before, the annual outlook, a beat and a raise across the board. For next quarter, they expect revenue to grow between 13 to 14% year over year. Current RPO to grow between 10 to 11% year over year, non-GAAP operating income to come in between $123 to $125 million, and non-GAAP operating margin to be between 19 and 20%. With regards to non-GAAP diluted earnings per share, between 60 to 61 cents, and non-GAAP free cash flow margin of around 5%. If you look at the full year, won't surprise you there, right? Total revenue growth of 12%, as we've seen before. Non-GAAP operating income close to $500 million. Non-GAAP operating margin between 19 to 20%. Non-GAAP diluted net income per share, $2.35 to $2.40. Non-GAAP free cash flow margin of around 22%. Management said that they began the new fiscal year with record non-GAAP profitability and cash flow as they continue to benefit from the operating efficiency actions they've taken over the past several quarters. Identity is security, and Okta is critical for organizations to modernize identity for today's threat landscape. With the advancements they've made on Okta's secure identity commitment and their growing product pipeline, they remain well positioned to advance their market leadership position and win more of the massive opportunity in both the workforce and customer identity market. They see the total addressable market at around $80 billion or so. With regards to stock-based compensation, year over year, it's actually down. Then if we look at the stock right now, it sits at $88.50, which is right under the 200-day moving average. This is on the weekly, so it will become extremely crucial to see if we can actually rebound over that area. Yes, it's true that we're now in an area where previously it was a resistance point, so maybe it can be a sort of support right now. The 200-day moving average sits at $89.43, the 50-day one at $96.05, and the 20-day one at $95.79. RSI is neutral. So overall, what do you get here? You get here a company that probably is getting overlooked right now by the market. We know there is also, let's say, a pessimistic view of software businesses right now for one reason or another. I mean, we've talked about that. The reason is AI is destroying every other business out there. In my opinion, that's not true. But specifically with regards to Okta, it's a forgotten stock because previously, if we go back to the graph here, previously the stock was around $270, close even to $300. And right now it has been flat-ish for around a year and a half or so. But in my opinion, and I think the numbers showed, this business is growing and it's now growing in a profitable way. That's usually a good combo. Now, whether or not you want to get exposed to this type of industry or buy this company remains up to you. I'm just here to provide some information. So that's about it. Share your thoughts down in the comment section below. Click all the buttons, the like button, the subscribe, the notification bell, do all of that. And I'll see you all in the next one. Bye-bye.